Good morning and welcome to Charting the Markets on Tuesday, the 7th of March 2023. Overnight, we had the Reserve Bank of Australia hike its interest rates by 25 basis points to 3.6%. It's a 10th rate hike in a row, and basically taking the interest rate in Australia back to levels last seen in May of 2012. And it's been the sharpest tightening with regards to monetary policy since 1989 in Australia. And we'll have a look at the impact this has had on the Australian dollar later on. But before we do, I'd like to mention also that overnight in China, we had a trade surplus for January and February, which came in higher than expected, whilst imports into China actually came in at a lower than expected number. But all eyes today are riveted on Jerome Powell, that is the Fed chairman's speech at the US Senate Banking Committee later today at 3 p.m. UK time, which would be very closely watched by financial market participants to see in which direction the Fed is going to be heading going forward. Because don't forget, about a month ago, only 3% of investors who track the potential chance of rate hikes in the US going forward expected a 50% rate hike to be seen in March of this year during the FOMC meeting between 21st and 22nd of March. And right now, that number has risen to a 30% chance of a 50 basis point rate hike being seen at the next FOMC meeting. So it'll be very interesting to see what further Jerome Powell can tell us about that, and we can discuss that later on when we look at the S&P 500, for example. But let's start off by having a look at the FTSE 100, and as we can see here on the daily financial bet, the FTSE has actually underperformed other European markets over the last few days because yesterday it dropped back down towards its October to March uptrend line here and just held slightly above there and also above the mid-January high. And since then has started to rise again in line with other European equity indices, and also on the back of retail sales earlier today coming in at a much stronger than expected 4.9% for February compared to 3.9% in January of this year. And also we saw the Halifax house price index rise by 1.1% in February, which came in much stronger than an expected 0.3% decline, and also a decline by 0.2% back in January of this year. So this positivity has led to the FTSE 100 rising in line with other European markets. And we saw yesterday, for example, the CAC 40 in France hit a new all-time high, and the German DAX 40 contract also heading to multi-month highs by rising above its February high. So short term, ahead of Jerome Powell's speech later today and tomorrow in front of the US Congress, we seem to see further buying with regards to equity indices taking place, not just in Europe, but also in the US. So let's just look at the FTSE 100 daily financial bet here, and you can see we've had this retest of support yesterday, followed by further upside today. And the technically interesting point now to look at is the early March high at 7,976. So if we were to rise above that high, which was made last Friday at 7,976, and close above it today on a closing chart basis, then it will be pretty likely that the FTSE 100 will also rise above the psychological 8,000 mark and hit back up again towards the February high at 8,044. So for me, that would mean that a rise above 7,976 is telling us that the recent consolidation phase has ended and that we are in store for further upside to take us towards the 8,100 area in the days and weeks ahead. So really technically quite interesting what is going on in regards to equity indices in Europe at the moment. Now, for the bears to be in control, we would have to see a fall, not through just the late February low at 7,854 taking shape, but also fall through the 10th of February low at 7,850. So basically, with regards to medium-term positions, if you're long the FTSE 100, as long as we stay above 7,850 on a daily chart closing basis, technically it looks as if further upside is likely to be seen. If you're short the FTSE 100, then perhaps it would make sense to reverse your position into a long position if we were to head above the 7,976 high made last Friday. So let's have a look at the German DAX 40 contract, because what we can see here is, as I've just mentioned, us taking out the high we made in February at 15,656. And if I then zoom out, you can see we are now trading at levels last seen in February of 2022 and are targeting the February 2022 high at 15,739. But above there, as you can see here, there are further upside targets which can be seen around the 15,800 mark. And then we have much more upside around the 16,000 area. But as you can see here on the daily chart, it's exactly what we've seen in January, or it looks like that, because basically we've had a sideways trading consolidation after a strong uptrend, and then further upside, and then another sideways trading consolidation, and then this hammer being formed last Thursday, taking us back down again to a 1 month low at 15,145, but only short-term intraday before we formed this bullish hammer formation, which was then followed on Friday by a bullish breakout to the upside, taking us through the February to March uptrend, downtrend line, breaking through that, and then also above the previous high now at 15,656. So the DAX looking very much bullish here with regards to the short and medium term trends now. And basically this will remain the case as long as we stay above last Thursday's low at 15,145. So let's have a look at US markets, because they are lagging European markets. As you can see here, the S&P 500 also broke higher last Friday and rallied by over 1%, but it hasn't come anywhere near its February high at 4,195 yet. But even here, if we look at the chart from a longer term perspective, you can see that we held above the October to March uptrend line with regards to the S&P 500 last week. And we reversed to the upside from this red line here, which is the 200-day simple moving average. And we did so the week before, bounced off it, and then retested it, and then again bounced off it and formed this bullish engulfing pattern last Thursday, followed by Friday's surge to the upside. Now, momentum is coming out of that upside momentum move because of Jerome Powell's speech later today at 3 p.m. in front of the US Congress. And in it, he will talk about the Fed and what the Fed might be doing with regards to its FOMC meeting on the 21st and 22nd of March. And he is expected to emphasize that rates are now at neutral levels, and that the Fed will actually closely look at the underlying economic data before making any decisions with regards to a further rate hike, and whether that is likely to be a 25 basis point rate hike or a 50 basis point rate cut remains to be seen. So that is why, because of this uncertainty, the upside momentum in the S&P 500 is at the moment slightly diminishing. So 3 p.m. really important for financial markets later today with regards to equity indices. Not just equity indices, will very closely look at the Fed Chair Jerome Powell's testimony to Congress later today, but also FX markets. And if we start off with the Australian dollar, we can see that even though we had a rate hike by 25 basis points earlier today, which was widely anticipated by the financial markets in Australia, with the Australian central bank raising its rates to 3.6%, the highest level seen since May 2012, the Aussie dollar versus the US dollar actually continued to decline. And that is probably because the rate hike was already anticipated, and we can see that the downtrend very much remains intact here, and that we're now heading down towards this key support area made up of the mid-November and December lows between $66.30 and $65.85. So further downside likely to be seen now that we're trading below that red line here, the 200-day simple moving average, with regards to the Australian dollar versus the US dollar. And as long as we stay below that February to March downtrend line, which currently comes in around 67.90. So that is the picture with regards to the Australian dollar. And when we move on to the US dollar basket, what we can see here is the US dollar itself last week and the week before trading sideways with a slightly negative bias here, as we can see, but we're holding above the key support area between 103.66 and 103.08, basically made up of the December lows, the early December lows, and also the high seen in early February. So that is really the key support area. And for me, technically speaking, as long as we remain above 103.08 on the US dollar basket on a daily closing basis, further upside is likely to be seen with regards to the US dollar basket. Now, when we look at euro dollar, which makes up 57.6% of the US dollar basket, you can see the inverse here. We've had a slightly bullish bias here take us to yesterday's high at 106.94 with regards to this currency pair. But if we zoom in here, what we can see is basically us being between a rock and a hard place. On the one hand, we've got really important resistance still taking us back to the mid-December highs and also the mid-February highs between 107.36 and 108.04. That's likely to cap any upside short term. And if we were to fall through 105.33, the late February low, then we are likely to head down towards this key support area between 104.84 and 104.44. But at the moment, we're just trading sideways with a slight bullish bias, but it wouldn't be surprising if we were to falter around the 107.36 area in the next few days with regards to this currency pair. Moving on to euro sterling. Now, this has been very interesting because yes, we've seen some stronger data out of the UK today, stronger retail sales, and also the Halifax house price index coming in at 1.1%, much stronger in February than an expected 0.3% decline. So on the back of that, you would have thought that the pound sterling could basically gain with regards to the euro, but the euro actually still remains relatively strong as it rallied yesterday on the back of several hawkish comments by European Central Bank members saying that far more rate hikes and rate hikes in the manner of sort of 50 basis point rate hikes are likely to be seen with regards to the European Central Bank reaching its terminal rate. So the euro looking quite strong, not just against the US dollar, but also versus the British pound, despite the British pound itself actually being stronger with regards to the US dollar, for example, but not with regards to the euro. As you can see here, the euro is still heading up towards the current March high, sorry, at 88.96. If that were to be taken out, we would then probably be heading to 89.28, which is the next upside target. And this view remains valid as long as we stay above last Friday's low at 88.27. Commodities have also been influenced by the slightly weaker dollar we saw over the last sort of couple of weeks. And if we have a look at Brent crude oil, here the picture is different because basically Brent doesn't really look that much at the US dollar, not as much as gold, for example, which is inversely correlated to the US dollar. And Brent, the correlation is far, far weaker, as you can see here, because Brent crude oil has risen quite strongly. Yes, the US dollar has come off for the last couple of weeks, but here you can see that basically we're back towards actually above the middle of this November to March sideways trading range, and we're heading back up again towards the highs seen in mid-February around $86.72. But here the really critical resistance to look out for is this area between the October low and the December and January highs between $87.99 and $89.35. So basically, as long as we stay below $89.35, further sideways trading with the potential to then head all the way back down again towards the $70 mark remains intact. But short term, we seem to be heading higher, as you can see here. And as long as we stay above Friday's low at $82.29. The immediate upside is likely to continue in the next few days, but it will depend also on what Jerome Powell will say later on when he speaks to the Senate Banking Committee in the US later on today at 3 p.m. Now, I've mentioned the gold price, and you can see that the gold price did benefit from a weaker dollar over the last week or so. It had 5 consecutive days of higher prices, take it up to $1,857 per troy ounce. But since last Friday's high, we have been coming off ever so slightly, probably also because investors want to see what Jerome Powell has to say with regards to the future monetary policy of the Fed going forward. So just some market players taking perhaps some money off the table here, because if you were long, for example, last week, it might make sense to now reduce your risk just before this speech by Jerome Powell later on today. And that's why the gold price is perhaps coming off ever so slightly today. If we were to rise in the next few days above 1,857 and close above that level on a daily closing basis, then the way is open to not only retest the mid-February high at $1,870, but also the 9th of February high at $1,890. So that would be next upside target. Downside target support you can see really around the mid-February low at $1,819, and that's also quite close to where this uptrend line, which goes back to October of last year, comes in around $1,817. And let me just finish off with a look at copper. And as you can see here, copper prices are also coming off. They're currently trading around $8,860 per ton. And here what we've seen is some sideways trading over the last few days and weeks. And basically, we are sort of in a small triangle formation here. If we were to fall through yesterday's hammer low on this daily candlestick chart below $8,811, then it's likely that we will also fall through the uptrend line, which goes back to November of last year at $8,760. And that would then take us down again, not only just to the February low, which is at $8,671, but also probably towards the high seen in mid-November and also in December, between $8,629 and $8,593. So basically, a drop through yesterday's low at $8,811 could take us down by about $100 or $200 in the days ahead. Now, if we were to see a reversal to the upside, and if we were to actually close today, Tuesday, above yesterday's high at $8,980 per ton, then we are likely seeing a retest of this downtrend line going back to the beginning of the year. And that could then take us back up again towards $9,212, the high seen in February. But right now, we're just in the middle of this trading range, and it looks as if the current pressure is pointing towards the downside. But we'll have to see whether that will change with regards to the testimony by Jerome Powell later on today at 3 p.m. and onwards to the US Congress. Thank you very much for watching Charting the Markets with me today, and please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.